Hello everyone, and welcome to this edition of the NZX Virtual Investor Event. My name's Oliver Logan. I'm part of the Capital Markets Origination team here at the Exchange, and I'll be hosting today's event. Before we kick into the presenters, we'll just do some quick housekeeping. So just to go over the format, each presenter will have about 10 to 15 minutes to present, followed by 5 minutes of Q&A, and Q&A can come from the floor, so please send through your questions via the chat. Following the event, there'll be a recording available online on YouTube, and also just a general note that anything in this is not to be considered financial advice. It's all just for general information only. Today we are lucky to have four pretty amazing speakers. First up, we've got Lewis Graydon, who is CEO of Fisher Paykel Healthcare. He'll be followed by Brent King, Managing Director of General Capital. Following Brent, we'll have Andrew Baskand, Managing Director of Harbour Asset Management, and finally Jonathan Oram, who's Group CFO at the Warehouse Group. So first up we have Lewis Graydon. Welcome, Lewis. Just to do a quick intro on Lewis. Lewis is currently Managing Director and CEO of Fisher Paykel Healthcare, a position he's now had for 6 years. Since joining Fisher Paykel Healthcare in 1983, I believe, as a product engineer, Lewis has had various senior roles in product technology and engineering positions. And across a 38-year career at Fisher Paykel, there's probably no one better qualified to be talking to us. So without further ado, I will hand over to you, Lewis.
Well, look, thank you for the wonderful introduction, Oliver. I really appreciate it, and we very much appreciate this opportunity to present via the NZX to our New Zealand retail shareholder base, which is really important to us. So just a bit of a thumbnail of Fisher Paykel Healthcare. It's medical devices. We've been doing this for over 50 years. And I think the key point for our business is we have demographics, we have other things that drive our growth. But the big growth driver for us is when we have something that is a change in clinical practice compared to what hospitals and clinicians normally do. We've estimated that the total market we are active in is worth about $25 billion, over $25 billion New Zealand, and it's growing, driven by that demographics. We're a business where plan A is to grow organically in our current fields. Now, normally a large proportion of our revenue is from recurring items, and I'll come back to that. Pre-COVID, about 85% of our business was from recurring, ongoing, per patient consumables. We invest around about 10% of revenue in R&D, strong product pipeline. Being a medical device business, we have relatively high barriers to entry. If you look back over our history is doubling revenue in constant currency terms every 5 to 6 years, and that certainly is the aspiration going forwards. For a very long time, we've been targeting gross margin, so the difference between our selling price and our manufacturing costs. Gross margin is 65%, and an operating margin of 30%, so it's kind of akin to an EBITDA. And we have we're a growth business, and we also have a strong history of increasing our dividend payments. If you look at us globally, I'll just interpret this for you a little bit. We have people, our employees, in 53 countries of the world. New Zealand, a little bit less than 4,000 people. The next one is about 1,500 people in Mexico, towards 1,000 around North America, about 400 people in Europe, and 500 people roughly in the rest of the world. So this is how we think of business. We talk about hospital business, and we think of that as invasive ventilation. So those are patients in intensive care, adult and neonatal, and they'll have a tube right down into their lungs. Then we have non-invasive ventilation. So that's where you have this mask covering the nose and mouth, and they'll be in intensive care or specialist respiratory units, or high dependency units. Then we have what we call hospital respiratory support. I'll interchange hospital respiratory support. Nasal high flow is the therapy. Optiflow is the brand name, and I'll probably confusingly interchange all three. So that's where the gas is delivered by a nasal cannula, adult and neonatal. And then we have what we call surgical technologies, and that's humidifying certain surgical procedures. We lump that all together and we call that hospital business. And then we talk about new apps or new applications, and that's the consumables for non-invasive ventilation, hospital respiratory support, and surgical technologies. Now, for every one of these applications, we will sell some hardware, an appliance if you like, and then we will get a consumable per patient treated. We'll come back to that. Then we move on to home care. So we have home respiratory support. That's a developing business, and that's utilizing that nasal high flow therapy in the home to treat chronic obstructive pulmonary disease patients. And then we have obstructive sleep apnea, or OSA. And for us, that's dominated by the OSA masks shown there. Now, this is kind of a graphic of how we thought about our business before COVID. We started in respiratory humidification, so that's intensive care here. And that was the primary growth driver. Obstructive sleep apnea became, let's say, the dominant growth driver, kind of mid to late 90s. And then what we're trying to show here is this continues to grow, but at more of a demographic rate. And so similarly here with OSA into demographics. And then before COVID, we would have said we were here somewhere. The primary growth driver was that hospital respiratory support. Before COVID, we estimated that approximately 50 million patients a year would benefit from this therapy. And in FY19, we treated about 5 million patients. So nothing to do with COVID. And then going forward, we thought that the next material growth driver would be home respiratory support. That's treating those COPD patients in the home. And then even longer term, we are developing a surgical technologies business. And we think of short term, believe it or not, as the 5 to 10 year time frame, 10 to 20 plus, just to put a context on it for you. If you look at the history, the revenue history over the last 10 years or so, you can see that steadily, we have achieved that aspiration of doubling about every 5 years. And then FY20, you can see the fourth quarter there were influenced by COVID-19 demand for our hospital respiratory products. FY21, you can see the COVID influence, and you can see it carrying on in FY22. Then when we move to net profit after tax, nearly 20% compound annual growth rate over the 10 years. And that is us steadily improving our efficiencies over the 10 years as we work towards that 30% operating margin, which we just about achieved in FY20. And then again in net profit after tax, you can see COVID impact kicking in FY20, FY21, and you can see that FY22 also some COVID impact. So it isn't possible to talk about our business right now without always coming back to COVID. So what I wanted to show you here is kind of conceptually how we're currently thinking of it. The history is the same. Then we kind of get to FY20 here, and we have this big lump in revenue growth. This grey curve here is what we were thinking before COVID. So that's before COVID. COVID hits, and essentially what we've had is over 2 years, FY21 and FY22, we've sold about 10 years worth of that hospital hardware. It's been driven by countries and hospitals acquiring the hardware to treat COVID patients, and you can see the revenue bump in that 10 years. I think it's towards about $900 million in those 2 years, $900 million worth of hardware. So we see that as a bump. We don't know where we are on this bump just yet, but definitely a bump up. About 10 years worth of hardware has gone out there over the 2 years. And in FY22, with that nasal high flow therapy, which is the predominant driver for treating COVID, we treated about 7 million patients. And that's with COVID, and that's with that hardware installed base. And then remembering that's out of what we thought was a pre-COVID about 50 million patients a year that would benefit from this therapy. So for us, one of the things that's top of mind right now is we've got this, we call it 10 years worth of hardware sitting out there. As COVID abates, as COVID slows down, as COVID hospitalizations, COVID treatments come back, we're focused on getting that installed hospital hardware used for general respiratory applications for the not COVID patients, getting more of those 50 million patients that would benefit. So if we can do that over a period of time of less than 10 years, we're ahead of where we were before COVID, and that's what we're trying to illustrate here. And then the other implication for the business is we're ahead, so we need to bring forward some of these other opportunities that we've been thinking of before COVID, and that's our R&D spend and investing in our sales force. So that was a real whirlwind around the business, really hard to avoid the impact of COVID on the business. Really, we're thinking of it as we've got a lot of hardware out there. We've got a job to get clinical practice changed to utilize that hardware for not COVID patients. And we've got a job to pull forward the other opportunities that we've been thinking about. And I suppose one other bit of colour, this change in clinical practice, that's what we do for a living. That's what we've done for 50 years. It's what our business does. And now we have a bit of an advantage in that the customers already have the hardware because of COVID, and they already know how to use it because of COVID. Over to you, Oliver.
Great, thanks, Lewis. And we do have a few questions which have come in. So the first one, who do you consider to be your main competitors? And has the recall of Phillips Cpap products in 2021 impacted sales favourably?
Yep, that's a double-barreled question. So for across the different parts of the business, for invasive ventilation, we're probably 80% plus of the world's market. There is a competitor there, Teleflex, and there's an alternative technology. So we see those as the competitors there. Non-invasive ventilation, for us, is really about humidification. Probably less than 10% of those patients are humidified. So really, we're competing against an old clinical practice. It's about changing clinical practice. Nasal high flow, last year we treated 7 million out of a possible 50 million patients that would benefit. So we'd say the primary competitor is changing clinical practice as well. Surgical humidification, we're leading that. No, directly, that's a change in clinical practice. Home respiratory support was the next one on the slide. We're leading that. That's a change in clinical practice. And then Cpap OSA, you've got ResMed and Phillips. Would be the competitors in a number of Chinese companies, or quite a number of companies competing in that business.
Yeah.
Now the Phillips Cpap recall. So maybe not everyone knows all about this, but Phillips have had a recall on their Cpap, which is the hardware used to treat obstructive sleep apnea. That means they're not placing new devices in the market. Most of this year, maybe through to the end of this year, they're busy replacing everything they've sold over the last 5 or 6 years. So that's removed a fairly major Cpap supplier from the market. And other manufacturers, and we're a very small part of that Cpap market, probably a couple of %. There's not much we can do to pick up that slack. And other manufacturers are struggling to supply Cpaps because on top of that, they've also got the well-known supply chain issues, global supply chain issues in electronic components. So other manufacturers have struggled to fill the gap, us included. So for us, that's had an impact on our OSA masks, which is a much bigger part of the OSA business for us, because when the patients are being diagnosed, they're not getting the hardware to be treated. So that has probably slowed down our OSA mask growth.
Cool. No, that's great, thank you. And next up, we've got, can you talk a little bit more about the business model generally? And the question is it akin to a razor and blade model where you sell hardware and then consumables to follow that?
Well, I mean, sort of. We sell our hardware and we sell it for a good price, because normally, before COVID and eventually after COVID, a hospital to change clinical practice is quite an investment. It's an investment in time and effort for them. And it's also an investment in time and effort and people for us to support them to make that change in clinical practice. So as a way of knowing that we're all committed to that change, we sell our hardware. Sometimes when people say razor blade, they think you're going to give the razor away to get the razor blade. So I just want to make clear we don't do that, sell the hardware, because both parties are making quite a commitment in time and effort to make that clinical change. So typically, once a hospital buys the hardware, they're buying it for a purpose and they're going to use it. I wouldn't call it a strategy. The reason it's a consumable is because your respiratory patients are connected directly to airways, and for cross-contamination, sterilisation, disinfection purposes, you need to use one set per patient. But it does drive quite a pre-COVID, quite a reliable, relatively reliable business, because once we've sold the hardware, we can kind of rely on the consumables. And that's what's changed a little bit during COVID, that we sold a lot of hardware to treat COVID. We need to make sure it continues to be used with less COVID in the hospital. So it's been a little bit of a change since FY20. But razor blade in the sense that we sell the hardware and then that generates the consumables.
Right. Yeah, no, that makes sense. Thank you. And last one, can you just share a little bit more colour around the surgical technologies business?
Oh, I'd love to. So our thinking was, you know, we want to double the size of the business in a sustainable, in a profitable, in a growth way. We'd like to double the size of the business over the long term. So every 5 or 6 years. So when you plan out far enough, and changing clinical practice, as you can see with nasal high flow therapy, we're maybe a little bit over 10% penetrated. We've been doing that for about 15 years. So changing clinical practice, developing the devices, developing the theory, developing the clinical data, developing clinical practice guidelines, and then actually changing what hospitals, how they treat patients. It's quite a long-term proposition, so you have to think out quite a long way. Yeah. So when we think out quite a long way to the 2030 year timeframe, you think we've got global distribution in respiratory care in hospitals. We've got global distribution into home care. If you take your spreadsheet out far enough, you want probably another horizon of growth. So for us, that's surgical technologies, which we've also been doing for over 10 years, I have to say. And the idea there is there's a number of applications, but the primary one is humidifying the CO2, which again is dry, used in laparoscopic or keyhole surgery. So this is surgery where you're going into the peritoneum, you're going into the, I don't know, that torso area where most of our organs are, and we're going in through small holes with instruments and cameras. And to give the surgeons access to that area, we inflate it. And it's really just so that they can get at the bits. So it's inflated, but it's inflated with dry gas. And you can imagine that's core body temperature, and that dry gas has adverse clinical effects. So one of the ideas is to humidify that gas, and you should get better clinical outcomes. That's part of the program. But the fundamental idea, and there are other potential applications too for open surgery as well. But the fundamental idea is to build a global distribution network into a surgical application.
Right, no, that's perfect. Thank you very much. Those are the questions for now, but if anything else comes through, we will get it through to you and make sure it gets answered. But thank you very much for taking the time to put together the presentation and join us this morning. I think everyone would have got a lot out of it, so thank you.
Thank you, much appreciated to have the opportunity. Thanks, guys.
No worries. Cool, so next up we have Brent King. Brent is the Managing Director of General Capital. For those who may not know, General Capital is a financial services group. They're listed on the NZX main board. Brent is joining us now. Prior to his current role as Managing Director of General Capital, Brent was the founder and Managing Director of the Dorchester group of companies for 17 years. And Brent has sat on a number of public and private boards with over 25 years experience in capital markets, most recently being Chairman of Greenfern Industries, which listed on the exchange late last year. So welcome, Brent. Looking forward to hearing from you, and I will hand over.
Thank you, Oliver, and congratulations, Lewis. That was outstanding. Yeah, so you've covered that first little bit. General Capital is a financial services group listed on NZX. We listed via an RTO back in August of 2018, so we're just coming up for our 4th year anniversary as a listed business. Our major business is General Finance, and it holds a non-bank deposit taker license. So this is very important. We can do lots of things with that license. 24/7 we can raise capital, so that's very important to us. Investors may know Investment Research Group. So we receive fees from restructuring and debt and equity transactions. We'll talk about that a little more in the next stage. The biggest takeaway for investors should be that we operate in a very regulated environment. Now that is a good thing because it makes it a very hard entry sector, and it gives the investor a lot of confidence. I think we've seen a lot of feedback about parties who are operating and raising capital in a area where there are exemptions. So the major thing for us is we have the strength of the regulation to support us. Our regulators include FMA, NZX, RBNZ, DIA, IRD, etc., etc. We seem to be filling out returns and filing schedules day to day. With that, of course, it's very high cost. And so at the start of our journey, it was quite hard to make $1 because your overheads were very high. We've now got to critical mass, and we now have very significant advantages over our smaller competitors. So our rapid growth has been part of our strategy to incur the cost early and grow so we can cover the costs of those overheads. And part of that is to meet those protocols and those procedures. We've had very strong procedures, one of which was to appoint very strong boards of directors. And I'll use that word in plural, boards of directors, and explain that in a second. So just moving on now, so that should change there. So we have the board of directors. I'm the managing director. Riwi Bugo is the chair and largest shareholder. Riwi is a person who is educated in New Zealand, both at Christ College and Canterbury University. His father was also. They operate mainly in Singapore, Malaysia, and New Zealand, splitting their time about a third. Lynn Lim is a professional director, and she's on other boards you will know, such as Restaurant Brands, etc. So very experienced professional director. Simon McCarley is maybe well known to you all. He did write the NZX regulations and was head of regulations for NZX. He was also the director of the Serious Fraud Office, and he put a number of the finance company directors and some management in prison after 2007. Very experienced at things not to do in the finance sector. And Paul Zingel is an investor, a very active market trader, and also a person who has extensive experience in property and the developments around property. So this is more detail. So in this presentation, you'll be able to read a lot more about Simon, Paul, Lynn, and Riwi, and of course myself. We see that directors are very important to this business because of compliance. I turn now to who is General Finance. General Finance was registered in 1997, so just past its 25th birthday in June this year. It was purchased by myself and some colleagues as part of the General Capital listing. We have a very solid board. We've got an accountant, a lawyer, a very experienced lender, plus myself as an experienced financier and managing director. An unusual factor with a non-bank deposit taker license is the parent cannot control the board. Very unusual. So they cannot have the majority of directors, they cannot have casting votes, etc. So they must be an independent party from the parent company. This, of course, is to stop things such as related party lending or influencing loans to other parties. So the General Finance Board is basically an island and reliant only on its own skills. General Finance is a non-bank deposit taker, licensed and ultimately controlled by the Reserve Bank. It means that we can accept deposits, we receive transfer of funds, and we receive applications basically 24/7. Sunday can be as busy as any other day of the week. Our first line supervisor is Covenant Trustees. We also have a credit rating, and if anybody has read the credit rating, it's quite an interesting summary of what General Finance does and points out its strengths and its weaknesses and how we compare with our competitors. So we have a BB- rating, and that's considered as near prime with low to moderate risk of failure. So that's quite interesting words. We're near prime with low to moderate risk of failure. What do we do with the funds we raise? So we lend to property owners. Our highest we will lend to is 70% of LVR. All of our mortgages are first registered mortgages. Most by far are residential, so 90% residential, 10%, maybe 9–10% are commercial. We of course have no unsecured or personal lending. All of our loans are unregulated, so we have none of the risks around the CCCFA that you will have seen over the last few years. That has been a minefield for many of the lenders. All of ours are unregulated, so we have none of the restrictions that the CCCFA and the various interpretations of that act that people have to follow. We're a relatively short-term lender, 3 months and is the shortest, and the longest is 2 years. So we'll stay with that medium term. We're basically a situational lender, and we can discuss it a little more if anybody would like to know more about that. But we have a very high cash flow, a very high recovery of our loans. To date, we've had no bad debts, and we have no loans that are in the non-performing category. So we've been very lucky, and we'd like to think very prudent in the risks that we've accepted. We have a very good spread of depositors and loans, which is basically geographic spread. We all know the impact that we've seen from events that are local, particularly Christchurch, where maybe the community didn't have the resource to be able to raise the deposits. So our ability to spread our risk on our depositor and our loan base is very important to us. We're the largest finance company in the non-bank deposit taker sector. We've just passed Liberty Finance in this regard, and there are some bigger credit unions, but we don't see those as competitors. They are cooperatives, whereas we're a straight company for profit. The others tend to be a mutual. They run their business for the benefits of their members. Excuse me. General Finance has a very solid and fast-growing brand. The components of the brand are the business is solid, reliable, and established. If you're a depositor, you're looking for those terms. You're looking for the situation where I can rely on you, I'll get my interest on time, you will have taken the tax off at the right rate. You know that we are a party who you can rely on. Others like to do things such as cute apps. That tends to turn off the population. The people who have money to invest passively are generally the older person. They want interest to pay their rates. They want to be able to pay the grandkids. They want to be able to use rely on the income coming on time. They don't want to take the risk that perhaps the return this quarter or the 6 months will vary. They want certainty. They want reliability. They want to perceive that we are a solid party to deal with. This is the board of directors. Donna Hatchway, chairman, accountant, former partner of a Big Four firm, very strong on compliance and governance. We have Greg Pearce, a very experienced lender and credit manager in a number of senior organisations around Auckland, very well respected lender and manager of loan books. We have Rob Hart, a lawyer, practice based in Waikato, very fast growing practice in Waikato, former New Zealand cricketer, and a very well-known person in the community in the Waikato, including in areas such as balloons over Hamilton, etc., and myself as managing director. So that is the board of directors of General Finance. I'm the only common director with the board of General Capital. There's some more detail on us there. Moving now to IRG. IRG is an NZX sponsor. We manage listings for companies, and we have brought companies to NZX and to USX. We look at what is the most appropriate platform for the company to list on and assist their listing. We're constantly approached for advice, and unfortunately most tend to be very early stage businesses, and I've done a number personally that you all know the names of. Greenfern Industries just October last year, Finsoft, which was 2000, and 42 Below and Charlie's. So I've done over 24 listings on NZX and enjoy that component of the business. We also help in debt and equity issues and raisings, and you'll probably know us from the yearbook. So we've done 45 issues of the yearbook, and we haven't been able to do those during the COVID lockdown, etc. Greenfern's a very interesting company. It's worth a look. It announced last week also. You should have a look and see if that's of interest to you as well. Turning now to financials, a really good year for us. Deposits up 52%, loans up 49%, cash up 128, total assets up 51, revenue up 64, and net profit after tax up 1,540% to 1.3 million. This is all driven off the consistent growth. So we before listing, the business had $1 million of equity. It's now up to 13.5 million and growing very strongly. We now have total liabilities, mainly deposits, of 89 million, and we've cracked through the 100 million of total assets. So you'll see this is a staircase, and as I say to people, we've had very good growth, but for those of you who know me, you know this body is not built for sprinting. Very much, I'm a staircase guy. It took me 17 years to build Dorchester to a $480 million business. And when I saw the market going crazy in 2005 and start of 2006, I got out of the market. I think the time is now right for a very good second tier business. And you can see that all the parameters are staircased. We have a full audit every 6 months. The result of that is the people gain confidence, investors gain confidence in us. Most companies, of course, are only audited each 12 months. We have full audit accounts of general finance each 6 months. The future will continue to grow our assets between 40 and 45%. We need to deepen our management base as that goes along, so increase management staff. IRG will undertake a listing in the next 18 months. We tend to do one about every 18 months to 2 years at longest. We'll increase our delivery via the portals. The online is very good, but as most of you will know, virtually all the finance businesses, starting with banks, have had hacking problems, DOS problems, etc. And that's flowed through. You have to have a very secure online presence to be able to shut away those nasty hackers, etc. Our profits are going to improve disproportionately because our overhead costs are covered. Our costs of listing, our costs of credit ratings, our costs of our systems are covered. That will allow a greater proportion of our revenue to drop to bottom line. We're also seeking other opportunities. We're a niche player, so we can make money out of niches that other parties can't. So we're looking for both acquisitions, but also acquisitions of loan ledgers. We'll have to ensure that we're on top of regulation. And you'll see under the opportunities slide, there's an increasing demand from regulators for us to be more covered over the next regulatory changes. And there's one very big one coming. A key for us is to continue to improve our credit rating, because that will simply decrease our biggest cost, i.e. our funding costs. So we're seeking ways to interact with our credit rating agency, Equifax, and to see what they will need to increase our credit rating and hence allow us to decrease our funding costs. Moving forward, the opportunities, this is the big one I just mentioned. There is the bill in Parliament and under discussion now, the deposit taker bill. This is designed to bring the deposit takers very much in line with the banks. And so we are expecting that we will be part of the deposit compensation scheme, i.e. the deposit guarantee scheme. And the RBNZ have said publicly that they expect us to be in this category and that we will have the same criteria as the banks, i.e. the first $100,000 of a deposit will be under this scheme. They may also allow us to use the word bank. That is still under discussion. The interesting thing for us is, are they going to allow a concept like neobank or mini banks? Neobanks are quite popular in other areas of the world, Singapore, Malaysia, UK, etc. Australia, of course. And so there may be the opportunity for us to move that one notch up and use that bank, the word bank. That will give a lot of confidence to parties wishing to deal with us. We're also in discussions with RBNZ about them being a party who can assist the non-bank deposit taking sector, particularly in times of a world financial crisis. And they're not agreeing to that, of course, at the moment. But the key for us is to be able to get a stronger to use the increased regulation to get us a stronger support under the more challenging times. There will, of course, be some costs and obligations with that, and there may be obligations for us to meet some of the criteria, particularly the obligations around the lending criteria, i.e. percentages of loans, etc. So we are watching that very closely. It's very important that everybody understands that finance is always evolving. It's amazing to see how quickly Afterpay has emerged, and the results of that company plus a number of others are similar. And there's no doubt that finance will continue to reinvent itself and taking advantage of the electronic communications, particularly via the internet. So do not think that finance is a static environment. It is a very dynamic environment, and it does allow the multiple growths very quickly. We're looking at mergers and takeovers. With the increase in cost, is it relevant for us to merge and join with various other parties? And if you think back over history, there've been lots and lots of parties that have rolled into banks, Countrywide, United, Ashburton Building, Southern Cross, Marrick, etc. They've all been in various variations. You've also seen now the banks have their own finance businesses, BNZ Finance, UDC, apologies for this typo, and Westpac Merchant, etc. So we do think there will be some restructurings as banks look to separate their businesses between traditional banking and maybe a finance company type sector. The opportunity also is for us to create a product which has retail and wholesale funding. To date, we've had the costs of retail, and that's been quite significant. Now that we've got critical mass, we are talking to parties about the opportunity to bring wholesale funding into the business and into the structure. This has the potential to reduce costs significantly for us. Risk management, really key. Everybody knows that the risk is higher in the market than it has been. What we've done is two very strong boards. Infrastructure, we've used service providers that have got very significant proven practices and procedures and able to deal with the hacking. The deposit, you may have seen us around, so the brand has lifted significantly. Spread of risk, loans and deposits, and also the credit rating. Why invest with us? We're selling at 5 cents when our net assets are 27. We're at a discount 27% to net assets. We grow consistently at 40% plus. Highly regulated, so giving confidence and strong barriers to entry. We are market leadership. We're the largest and the fastest growing. We've got excellent governance systems, and we're very confident that the strategies we've put in place will deliver increasing profits, and the market will recognise that over time. Thank you for listening to me today. Sorry to go on a little bit long, but thank you very much.
Great, thanks, Brent. Very detailed and good overview of what you do at General Capital. We've got one question that's come through quickly. Could you comment on what the impact of rising interest rates might be on the business? Assuming obviously the net interest margin between deposit and lending is a driver of revenue, etc. So could you comment potentially on some of that?
Yes, absolutely. So generally, it's a little bit like, to use a terrible example, the cigarette companies, the margins stay and grow even though the price grows. So you get a bigger margin on a higher price, and that's better. Just to give you an idea, our funding costs are running at the moment, average funding costs historical, are running in the mid fours, so about 4.5, 4.55, and our current lending rates are 11. So the demand, because the banks have been so tough on lending, that particularly people are able to and are happy, because of our short term, we're able to charge a very high rate, and it's not significant over a 3-month period. So we found that our margins have actually blown out, and our LVRs have dropped, our margins have blown out, and we are in the best trading time that I can recall in the history of second tier. So the demand is high and driven off the bank saying no. We love the bank saying no.
Great. Cool. Thanks, Brent. We will have to keep moving along, but thank you very much for your time and for presenting. And yeah, we'll keep in touch.
Thank you very much, Oliver. Thank you.
Great. So we're now just going to move on to the world of investment management and welcome in Andrew Baskand of Harbour Asset Management. So welcome, Andrew. Just a quick one on Harbour Asset Management. So founded in Wellington in 2009, Harbour is an investment management firm with clients across KiwiSaver funds, charitable trusts, iwi, and corporate superannuation. As a fund manager, Harbour has a range of different funds across equities, fixed interest, and some derivative asset classes. Andrew himself has over 37 years in investment management across a wide range of roles at the Reserve Bank of New Zealand, Bank of England, AMP, and Merrill Lynch Global Asset Management in the UK. So very experienced, and we're lucky to have you on board, Andrew, and what's a pretty choppy time for markets, so I'm sure everyone will be interested to hear what you have to say.
Yeah, well, thanks, Oliver. Thanks, NZX. Thanks to my colleague Mitch for putting us in contact today. So it's excellent to be able to talk about the context of the markets, and that's what I intend doing rather than getting down any rabbit holes. I guess everyone can see the presentation in front of you, and so let's just move into the context of why the market has had this volatility, and the key reason is this very sharp move in bond yields that we've seen since late 2021. And that move has been a global move in bond yields, and that's created an enormous amount of volatility in markets. And so just moving on to the next slide, that volatility in equity and bond markets has been quite extreme, but not as extreme as we saw in the GFC or in periods of volatility in the 1990s. But that volatility has contributed to a significant fall in rates. Sorry, just have a little with the mouse here. In markets, with global equities, of course, falling this year by close to 20%. And the New Zealand equity market also down almost by that amount. The surprise really is the extent to which investors have seen capital losses on global bonds and local bonds with the sell-off. And that's not a surprise potentially to professional investors, but clearly to retail investors. So the key question really is, are we at the point now of seeing a significant change in the variability of both inflation and GDP, which would create a changed risk uncertainty for markets? And the last 30 years has been characterized by reasonably low volatility in both growth and inflation. And lower volatility has meant that we've requested as investors a lower risk premium, both on bonds and on equities through this time frame. It's not that this time frame wasn't characterized by a number of significant recessions or geopolitical events that created market volatility, but perhaps nothing like we've seen recently, and nor comparing also in this chart to the prior decades from the 1960s through to the 1970s, when we last saw inflation spike as we have today. So globally right now, in response to this significant rise of inflation, we've seen a lot of tightening put into the pipeline. The chart on the left here shows the speed with which tightening expectations have been thrown into markets. Only 9 months ago, we had no expectation that the Fed funds rate would accelerate the way it has, and the move from a zero Fed funds rate expectation all the way to a tightening of almost 2.5% has been now put into the market. And the slide on the right here shows what markets anticipate for 1 year rates in 1 year's time. It's called the 1 year swap rate, 1 year forward. And only once again, a year ago, rates around the world were anticipated to be near zero. And now, of course, we've seen in New Zealand that 1 year interest rate swap, 1 year forward rates touch over 4%. In fact, it even pushed through to 4.5% only 2 or 3 weeks ago. So that tightening very meaningful. And so we asked the question, although there's a lot of tightening in the price, what has been the historic relationship between Fed hiking cycles, or hiking cycles generally, and markets? And what we can see here clearly on this chart is this tightening cycle has been associated with a significant derating and fall in the US equity market, more than we've seen in the last 5 tightening cycles. And on the right-hand side, that's been associated, of course, with US 10-year yields rising by as fast as they did in 1994. So the question we're asked regularly is, well, has that tightening now resulted in equity valuations that are becoming attractive? And this slide attempts to answer some of those questions, because we see a tight relationship between growth-oriented stocks, such as those listed on the NASDAQ, and the yield on longer-dated bonds. So on the vertical axis here, we have the US 30-year bond yield, and on the horizontal axis, we have the 24-month blended valuation, the price-earnings ratio of the NASDAQ. Once again, only 6 months ago, the NASDAQ traded at some 31 times its forward earnings, 31 PE, and that was associated with US 30-year bonds closer to that 2% mark. Now the 30-year bonds trading, well, just a little under 3% today. It did top out above 3%, and we've seen the NASDAQ fall by about 30%. In other words, the NASDAQ PE has gone from over 31 to around 21 today, reasonably tightly correlated in this short time frame. And so we can look at the broader US market as well and compare the overall valuation of that market with real yields. Real yields are most often more associated with equity market valuations. And you can see a loose relationship here between the real yield in the US market and the S&P forward PE. Now, real yields have actually normalized. They're back to a positive number, close to 0.6, 0.7% in the US, indicating combinations of the tightening cycle we've seen, but also term premium being thrown back into the US bond market. And the US forward PE is close to 17 times the day. Pretty normal relationship. And so we can look also at longer term relationships between bonds and equities in real terms here, or in nominal terms. We can see that there's nothing unusual regarding these charts relative to history. You're being paid an equity risk premium in both real and nominal terms, not too far distant to that of the last decade and a bit. So if on evaluation grounds, the equity market is attractive, or at least in some form of equilibrium, what are the current concerns? And the concerns are, of course, over the extent to which this tightening of monetary policy has started to turn down the economic surprise indices. In fact, in every region apart from Australia, we've had negative earnings and economic surprises. And here we have the chart on the left here showing the recent history of economic surprises. And for the most part, post-COVID, we had economies having economic data providing positive surprises. But since March and April of this year, we've seen a sequence of downgrades to the outlook for growth. On the right-hand side here, we have forward earnings estimates for the major markets. And interestingly, we haven't seen any of these forward earning estimates really roll over yet, despite the economic data. So on the one hand, equity valuations are fine, economic surprise indices are falling, but on the other hand, we haven't had revisions down yet for equity earnings. Where do I think we're most at risk? Well, here I break down the US equity market, the S&P 600 index, into its value component and its growth component. So classically value shares, combinations of energy and financials, consumer discretionary, housing, whereas on the right-hand side, classically with healthcare stocks, we have technology stocks and other growth-orientated sectors. What's really interesting about this chart is the extent to which we see expectations for the value sector to continue to have high EPS growth into a downturn. And I think the two pale blue bars on the first chart here are at risk of quite significant downgrades as we move forward, whereas already we have lower earnings baked into growth stocks. And in part, that's because some of these stocks receive earnings from advertising revenue, particularly those US technology stocks. So I think there's a more realistic scenario here for growth stocks. So I'm turning and changing speed now into New Zealand, getting back into the interest rate cycle here. Here we show the official cash rate forecast going forward. The light brown line is the expectations provided by the Reserve Bank of New Zealand. And the other two lines are more recent estimates, latest one taken earlier this week and 1 month ago. Fairly consistent here and showing once again that the market thinks the Reserve Bank will take rates here to a little over 4%. Now, in the shaded area here is the Reserve Bank's estimate of a neutral range for the official cash rate, 2 being almost the midpoint here. And the expectation, of course, for a time frame is we'll need tighter monetary policy. I'm developing here my first view that I wanted to present today, which is I think the market here is over-egging the aggressive tightening cycle. And where to invest right now, this is one of 2 views I'll throw onto the table. We actually have moved quite aggressively to buy or to be long in our duration of the 0 to 3 year area and a little bit even further out at the New Zealand curve, the New Zealand interest rate swap market. And that's because we don't believe rates here will head over 4% in this cycle, given what we're seeing with respect to consumer and business confidence. And today we had the QSBO survey come out as well, which indicated a significant further reduction in confidence. Now, we're not saying this is necessarily going to stop the Reserve Bank immediately right now, but as we go forward over the course of this year into 2023, we think there'll be cause for some form of pause in that tightening cycle. So just building up my second case here for where would we invest right now. Once again, here we show the New Zealand market similar to that NASDAQ chart and the relationship of the valuation of the New Zealand market to real 10-year yields in New Zealand. Quite a tight relationship here. The New Zealand market is a utility-like defensive market with a few growth stocks. We don't have a lot of large cyclical names. We don't have energy companies, for example. We don't have a lot of large financials or banks here. And so we do see this tight relationship between the valuation of the market and bond yields. So only a year ago, almost 11 months ago here, we had the New Zealand market trading on a price earnings median multiple of 24 times. And that derating of the market has been quite significant. So we're trading only on 17 times today, sort of back into the pack and implying 10-year real yields could actually lift a bit more from here. So we think there's a bit of a cushion building into the New Zealand equity market following this significant derating. Building up my case for where I would invest right now, I offer this chart regarding the valuation of 2 global growth sectors, technology and healthcare. A little over a year ago, we had the US tech sector, NASDAQ heavy, trading at over 28 times. The NASDAQ itself, as I said before, over 31 times. Those valuations looked a little extraordinary. And as we've seen bond yields sell off, we've seen that tech sector derate to a PE of only 20 times. But what I find extraordinary about this chart is the extent to which the healthcare sector, a reasonably high growth sector, is only trading on 16 times forward earnings. Actually, that is less than the market multiple today. And I find this a very interesting perspective on markets. So interesting that I really think that the one thing we can be certain about today is demographics. And what we know in New Zealand and Australia is we're entering a period where we'll have that consistency of our population aged 65 or more continuing to rise on quite a steep slope, steeper than that of the rises we see offshore. I think this lends itself significantly to still considering the healthcare sector as being very interesting. And even if I don't have a perspective regarding where bond yields might be going, I think bond yields might be entering a period of slightly lower volatility. But even if I didn't have that as a perspective, I don't see a strong relationship between the US healthcare valuations and bond yields. Unlike that NASDAQ tech-heavy sector, I think we can have less certainty that bond yields will drive US healthcare and healthcare valuations more generally. So at a valuation range of around 16 times for the sector, I think it's reasonably attractive. So when we look into our portfolios today, in fact, and linking almost to Fisher Paykel Healthcare, the earlier presentation, we are very significantly heavily overweighted and invested in the healthcare sector. We're close to 15% overweight, which means overall we have around about a 40% exposure in our core portfolios to healthcare. We've made significant changes in the last 6 months. Fisher Paykel Healthcare is now again one of our largest investments in our portfolio. We've increased by about 4 or 5 percentage points that position in the last 6 months or so. Additionally, we've lifted our positions in Ryman from having almost none to over 2% today. And in Australia, we've lifted our positions in both CSL and Ramsay Healthcare. Overall, around about a 10% swing in the portfolio in the last year. So those are my 2 key conclusions where to invest today. We do like that short end of the New Zealand fixed interest curve, and in most environments I can paint, we do like the healthcare sector globally, and spilling into that, we're quite attracted to that sector in Australia and New Zealand. So I'll stop here, open it to questions. Just once again, disclaimer, nothing I've said today is for investment advice. It's for general information purposes only. Thank you.
Right, thanks Andrew, really interesting, and yes, some great detail in there. Would you be able to just first off maybe speak a little bit more to the relationship, maybe what underpins the relationship between bond yields and say equities, or in particular growth stocks? You know, we saw that graph where tech growth stocks rose pretty substantially in terms of valuations as bond yields maybe started to drop, and then as it's gone the other way, that's fallen away. So could you comment maybe a little bit more for those who might not be familiar with how that relationship works?
Well, look, there's a mathematical perspective. We can go Google the Gordon's growth model, and within that model, one of the key driving factors for how you value equities is, of course, the bond yield. So there's a mathematical side to it that's well known for investors. But on a practical perspective, consider this. As interest rates generally rise, and uncertainty may increase, you will have investors being happier to place their funds into a higher interest rate environment. That means they will demand a better or higher potential return out of equities. And that's a general perspective, which means the pricing of equities needs to change. Now, why growth stocks? And the reason for that is the earnings of growth stocks are further in the future. They're more distant in the horizon, and therefore when we technically discount back those earnings in the future, the power of the interest rate in future earnings is stronger. So we observe this relationship particularly for growth stocks and for utilities as well that have moats around their business and are very long-term in nature.
Right, thank you. And another one, again, not any specific advice, but is there anything sort of generally that you look at when assessing healthcare companies? And following on from that, are there any kind of specific, I suppose, subsectors within healthcare that get you excited?
I think the first thing is when you're investing in equities in particular, you're investing for a long time frame. So with that long time frame, you want to have a view that the companies you're investing in have a potential to continue to grow their earnings and, if possible, at higher margins. So we're looking for healthcare companies with large total addressable markets. And I forget the number that Lewis brought up earlier, but I think he said something like 25 billion was his total addressable market. So we're looking for need that's increasing, aged care demographics, but also total addressable markets that are very significant. And often with Australian and New Zealand healthcare companies, we want to see their capacity to penetrate global markets, which are, of course, 10 times, 20 times larger than what we can address back in Australia and New Zealand.
Perfect. That's great. Thank you very much for that, Andrew. I'm sure a lot of value out of that given where things are at. So thanks again for your time, and we will leave you to it.
Thanks. See you, Oliver. Bye.
Great. And now, certainly not least, but lastly, we have Jonathan Oram, who is Group CFO at the Warehouse Group. So welcome, Jonathan. Can you join? So Jonathan's had a career in finance spanning over 20 years, including 15 years in investment banking at UBS New Zealand and Macquarie Capital. Since joining the Warehouse Group 3 or 4 years ago, Jonathan's been CFO, and in that role has been managing the group's business advisory, financial reporting, governance and risk. Jonathan is a chartered accountant and has a Master's of Commerce and Economics from the University of Auckland. I'm sure everyone tuning in will be familiar with the Warehouse and what you do, Jonathan, so looking forward to hearing the update from you. I will leave you to it.
Thanks, Oliver. And look, great to be part of this session today. I think the webinar format's great opportunity to reach a much wider audience. Last time I did this was in person about 2 years ago, and I think you probably had about 60 people versus the several hundred you've had sign up for this event. So look, first of all, just wanted to give a quick overview of who we are, just to remind people of our position in the market. We are the largest non-grocery retailer, about 11% plus of non-grocery spend across 4 major trading brands, being the Warehouse Stationery, Noel Leeming and Torpedo 7, with the Warehouse being the bulk of the sales at 51.8% of that's a half-year sales result, which was 1.7 billion, and a full-year sales number last year of 3.4 billion. Another key element of our business is the market, which is an online-only marketplace, and currently we sell about 40% on any given day of the market sales made up of group brands. And we gave guidance at the half year. We're expecting that the market will have what we call a gross transaction value, GTV, of in excess of $100 million for the full year. Online sales, growing importance, especially over these COVID times that we've been through. And at half year, it's sitting at 19.4%, and click and collect was sitting at 50.1% of online sales. In terms of where our priorities have been and continue to be, building. I'll start with 2 on the right: building the future experience and investing in our infrastructure. Those have been the 2 priorities in recent years, and in particular in building the future experience. A lot of time spent on improving that online journey, and hence the growth we've seen there. 67.8% growth at half year. This is half year in FY21, and we've been looking at rationalising our store network to better suit what we think customers want in terms of how those stores are performing. So it's more of an optimisation than a complete reset, and continue to tinker with that. 33 stores so far have had what we call a SWAS in terms of red stores, which is where we've been putting Warehouse Stationery stores into a Warehouse. Stationery is still branded, and you still get the Warehouse Stationery experience largely in those Warehouse stores, but it's a matter of optimising and getting a greater yield on that footprint. Investing in infrastructure and selling retail fundamentals. Quite a lot of major work has been ongoing around core systems. It's fair to say we would say we've had a bit of a technical debt in terms of investment in systems in the last 15, 20 years, and so pretty much every core system we have has been revisited, and we're largely there on our warehouse management system, partway there on our ERP, finance and inventory. Part of that's live, rest will come live post year end, and we're working on things like group order management system, which is how online orders get allocated and fulfilled either through stores or through fulfillment centre. On the left is where we've got an increasing area of focus, which is around building a customer ecosystem, and I'll come on to that in a couple of slides. So look, transformation journey. This slide is something we've presented a few times in various formats. It's grown in terms of the number of phases. It really started when Nick Grayston, our CEO, he joined the company just over 6 years ago. In terms of trying to simplify, originally the core functions that support our stores. EDLP is everyday low prices, is a very big step in the warehouse business in terms of simplifying the way we turn up to customers. It's about delivering value every day. So rather than the high-low model we had before, which resulted in a lot of promotional activity, but also carrying a much wider range of SKUs and generally just a less efficient way to actually deliver products as low at a low cost as we can to customers. RISE was quite a major program of micro initiatives. We've touched on that many times before, but a lot of value was realised out of that. 250 plus initiatives around one-off capital and recurring revenue and earnings initiatives. Agile's ways of working, I would just touch on that, in that rather than going into the ways of Agile, we're one of the first retailers globally to actually do this across our full corporate function. The key benefit that we've seen there is actually the alignment on strategy across all our brands. At one stage we had 5 CEOs. We had effectively quite a few silos in the business. We've broken that down through Agile, and so there's a much better efficiency and allocation of capital and labour across the business and executing strategy. Systems and processes we've touched on. Digital future we've touched on. Customer, in terms of our sustainability journey, that is actually in terms of the different levels of transformation that we're going through, that's the one that's least mature, because we just see, even though we've been at carbon zero in terms of scope 1 and 2 emissions since 2019, we've still got quite a long way to go on that journey as we look to decarbonise our business here and our supply chain to the products coming from where we source products, but then further up into our suppliers, there's a journey to go on there. In terms of the ecosystem, this is all about how we can better or best deliver the products and services we have as a group to our customers. And the key part of this, something we launched just before Christmas, is the Market Club, which is a group loyalty group membership program, and that's replacing what has been up to 7 different loyalty programs across the group. It's incredibly important to have that, not only from a customer data perspective, so that we're consistently seeing customers across our brands, but also just how we can best surface what's relevant to the customers and wherever they turn up in our ecosystem. Part of that as well is trying to add more services to what we can deliver. So whether it's consistent payment, functionality across our brands, to new things like online prescriptions. We've taken a stake in Zoom, which is an online pharmaceutical business, or pharmacy business at least, and that's something that we'd look to hopefully in the near future, start to be able to provide a more integrated offering to our customers who are part of the Market Club. In terms of sustainability, as I touched on a journey there that we're on, we now have a dedicated environmental and social sustainability committee, which reinforces the emphasis that the board is putting on making progression here. We've made progression around some of the, I guess, more operational elements in terms of diverting operational waste, scope 2 emissions in terms of what we can control. We year on year have been making reductions there. In terms of sustainable products, that's an area where, as I touched on, in terms of how we source products and what how they're manufactured, and the raw inputs that go into them. An increasing focus in the last financial year, we had 17,500 unique sustainable products, 111 million out of 1.7 billion that the warehouse sold. So in terms of products that we can say have a sustainable attribute. And we continue a large amount of charitable work, and that's something we still have a very strong focus on how we can best use our efforts there to further causes in the community. And we've taken out sustainable linked loans. 140 million of our bank facilities at the moment are sustainably linked, and as part of that, it's trying to get a third party check on what some of our targets are. And there's a small benefit in cost in terms of margin that equates if we hit those targets over a 4-year period, and we'll look to move more of that as we become clearer about our long-term sustainability targets. In terms of historical financial performance, next 2 slides. The journey we've been on certainly the last 6 years, with COVID, we had a steady, solid low single-digit sales growth, and we've been really focusing on gross margin improvement. So across the group, we've seen that steadily increase. Hard to really interpret what happened in FY20, but FY21 certainly, benefit of some very strong consumer sentiment and tailwinds at the time. Probably, we'd look back and say that they're definitely buoyed by that, and so that was a record year. $3.4 million of sales, $240 million of operating profit. As we stand at the moment, half year, our margin was down 150 basis points, and that's still up though. If you look at the trend, it's been steadily increasing over the period, over the last 6 years. And that was what we saw at half year was really the impact of greater online sales and mix and sales impacting and margin in terms of product mix, but also shipping costs beginning to come through. That's something we've actually only really seen come through in force in the last 6 months. And thankfully in Q3 we did note that we've actually managed to maintain margins with Q3 last year. So it's something that we're just having to adjust our pricing as we go through, see more of this inflation turn up in our products. But it's that's an area that we're very focused on and have been over the last few years. Online sales, you can see the considerable growth we've had in online. 19.4% of sales at half year versus circa 12% in FY20, and click and collect becoming the preferred means for our customers to pick up their goods. And finally, look, balance sheet, we've come a long way from where we were back in 2017, $200 million of debt, and prior to that we were running close to $300 million of debt. We had a financial services business. We exited that, and we've been on a steady trajectory of increasing our funding capacity. As at half year, we had $150 million of cash and $330 million of undrawn banking facilities, and we now run a policy where we're looking to maintain liquidity of $350 to $450 million. It makes sense in the current environment and in terms of volatility. And also given we've got a very large portfolio of stores which are largely leased. And dividend, we've consistently paid a dividend policy. Historically was 75 to 85%. We revised that at the end of last year. We're now paying a minimum of 70% of adjusted net profit after tax, and we declared a 10-cent dividend at half year, which actually represented close to 100% of net profit after tax for the half year. But that really reflected what was a very difficult first half, with 84 days of being at level 3 and 4 included in that period. So without any more content, I'm ready to take questions. Over to you, Oliver.
Great, thanks, Jonathan. Do have a few questions that have come through. So first one, I suppose just with the context of a lot of retail moving online, and as you pointed to in your presentation, that's probably something that's reflected for the Warehouse Group. Are you planning to keep expanding physical footprint, or is there going to be a kind of a pivot towards more of the online offering?
Well, I think there's a couple of elements there. First of all, with the portfolio of brands we have, we see the opportunity to really optimise the brands within that footprint. So we may be at peak footprint in terms of square meters, but we'll continue to look at how we best turn up in those sites. So, for example, Torpedo 7 has moved into some of the warehouse stationery sites that we've vacated when we've moved warehouse stationery into a warehouse store. And so, look, it's just an ongoing, optimization rather than a retrenchment of physical retail. I think generally as a comment as well, New Zealand hasn't been as exposed to excessive square meterage as you would have seen in Australia or even the North American market, which is, literally at a multiple of what we have in New Zealand. Secondly, with online, we're seeing, and this is a trend globally, is that actually you need to have a physical footprint as well as satisfying online orders directly to customers' homes. 50% of our online at the moment is click and collect, and so we are finding a lot of customers do want to come in, find it more convenient, removes the uncertainty of that last mile, and they pick up something else while they're in a store. So we see it as a very important part of that journey. And the last comment would be is we do have some categories that are growing. We obviously in a relatively modest way, we've been increasing our exposure around grocery. We've had a business for a long time there, but it's focusing more on that general top-up shop, as people can see in what we've been advertising, and moving in potentially into other categories is always an option, especially when we're in the bigger sheds the warehouse operates in.
Yeah, perfect. Thanks. That covers it off very well. And as a follow-up, is the entry of the likes of Costco or other big international retailers having a significant impact at this stage, or is there anything that's being done to prepare for those entries of maybe larger competitors?
Look, it's all part of the increasing, the total offering we can give to customers. So things like the Market Club are an important, tool in that competitive environment. The market itself, in terms of the group marketplace, and we'll continue to invest into that. But we expect, and we have been expecting for a long time, that we'll see more competition turn up in New Zealand. Costco will have an impact, but it's something we're well prepared for, and I suggest that there's lots of other areas that are going to impact as well.
Yeah, great. That's it. So thank you very much for your time, Jonathan, and for the time presenting and preparing. And yeah, we'll look forward to having you back on at some stage in the future.
Thanks, Oliver.
Great, and that concludes the event for today. Just a quick reminder that there will be a recording available following this on the NZX YouTube channel for those who might want to revisit some points, or for those who were not able to join us live. Our next event will be on the 10th of August, and so there will be an invite sent out for that shortly. But thank you everyone for attending, and we will see you next time.